Hello, and thank you for joining us at xm.com for this Forex Preview video. We'll be having a look at U.S. data out on Friday. I'm Cristina Marujos, and joining me today is Cristina Barcenido, investment analyst. On Friday, Cristina, we'll be getting another important report out of the U.S. following Tuesday's PMI readings, PCE, core inflation, and personal consumption and income, which are likely to give us some clues as to how people and the economy, of course, are getting back to normal after weeks of being in lockdown. Do you think investors should be optimistic?
Hi, Christina. Well, I believe the report will be overall a positive one. We expect a sharp rebound of 9% in personal consumption after the steep fall in the previous month, and a modest increase in the core PCE inflation index, which is forecast to strengthen, but not enough to enter the positive area, rising from minus 0.5% to 0%. Well, if this is the case, the message we get from this data is that the slump in the consumption in the previous months is temporary and the economy is recovering, as retail sales indicated last week, all suggesting that the worst could be behind us and we could have a smoother GDP contraction in the second quarter than we initially believed. Of course, we are still well below pre-lockdown normal levels, and although governments continue to move forward with their reopening plans despite the slight pickup in virus cases, consumers and businesses are expected to behave cautiously until an effective vaccine is released in the market. So a recovery could be gradual in the coming quarters, and that may keep inflation subdued and well below the Fed's 2% target, which is a highly likely scenario priced as the government is trying to keep costs for businesses and therefore prices low through its stimulus programs to motivate spending. On the other hand, though, I'm optimistic that inflation may not take long to accelerate towards the target. If not this year, then we may see more sustainable upside pressures in the following years because economic conditions before the virus outbreak were more favorable than in 2008 financial crisis. The banking sector is healthier and banks are not requested to hold a larger amount of reserves, so they should be more willing to relax their loan terms and allow the stimulus to flow smoothly to consumers and businesses. Moreover, the corporate debt as percentage of GDP remains in a downtrend after the peak in 2008, and the outlook for the housing sector is brighter than back in 2008, and we see demand rebounding in the past 2 months. So all this could prepare a fertile ground for inflation, but I think only after restrictions are fully removed and consumers and businesses get really convinced that the virus spread may not see more spikes, while more stimulus may be required from the government to push the unemployment rate down. It's also worth noting at this point that the one-off unemployment checks will expire in July, and that may push the personal income reading to the negative area on Friday.
How do you think these data could affect the dollar's moves, though?
Well, unless the data disappoint us or we get more virus increases in the coming days, which could move more demand towards safer assets, I think the data could give some room for improvement to the dollar. We could see another test of the 20 and 50-day moving averages in dollar-yen. From a technical perspective, there are some downside risk in play in dollar-yen, but I think losses could pick up momentum only below the previous low of 105.97, which acted as strong support yesterday, and a break of which could put the pair back in a downtrend in the short-term picture.
Cristina, thank you so much for joining me today, and thank you for watching this Forex Preview video for U.S. data out on Friday here at xm.com.